All right, traders, welcome back to another episode. So I promise that I am going to be discussing about what we call IFC candle, and also a particular topic that is important for everyone to know. Um, as a trader, you must at least know this very important topic, because this will really, in fact, help you a lot as you are coming up. It will really help you a lot, you know, to uh to boost your knowledge and boost your win rate um, in in terms of trading and in terms of making money. And this other topic is called CRT, which is candlestick range theory. And what is these two topics? Why is it so important, and how do I use them? First of all, I literally do not use CRT as a main topic, as a main strategy, but I notice, or I come across them. When I come across them, I take note of them. So, when I see that, okay, the CRT has formed, I take note of them that, okay, there is a reversal that is going to take place. And how can we use the CRT? And also, what is an IFC candle? So I will be starting from the topic, which is the candle range theory. And what do we call a candle range theory? A candle range theory. What do we call that candle range theory? So let's have it this way. Candle range theory. Right now, let's have it this way. A candle range theory, it's simply just you understanding the theory behind a candle, right? How does the candlestick move? Now, how does candlestick move, and when do you expect a reversal to take place, or when do you expect a continuation? How does the candlestick react? What does the candlestick seize? Do you understand? So a candle range theory, in terms of candlestick, it means mastering the candlesticks properly. Now, once we have an engulfing candlestick, if you are not new to trading, you will know that an engulfing candlestick, let's assume this is a bullish engulfing candlestick, you will know that most bullish engulfing candlestick could be a reversal or a continuation, right? And then if it is a rejection block, you'll notice, or you will realize that a rejection block means what? There is a boundary, or there is something that is holding the price or making the price react in that particular zone. So are we together? So this candle range, this theory, this candlestick, all these rejection, engulfing candlesticks, pin bars and the likes, they are all candlesticks which gives the theory, which gives a reason, right, for us to know we have a rejection at a particular zone. And this rejection can cause a reversal or perhaps a continuation in the chart. So now let's go deeper into candle range theory. Now, one of the techniques, because I'm not used to candle range theory, and then I do not focus my strategy using the candle range theory. Now, as a trader, you might intend to choose any of the strategy you want, right? And then you can modify to your own style, and that's what we call a professional trader. As a trader, when you are trading, you're trading strategies you learned from someone, or you learned from perhaps any place you've learned it. You modify it to your own way, then it makes you profit, and then you master that modification, that the strategy you learned from someone, and then your modification and refinement, you call it refinement. You refine that strategy, Then you blend it to yourself that that strategy and you becomes one. And then when the strategy becomes one with you, then you know when you find your way around. You understand? So now let's go deeper about candlestick range theory in Forex. So now these are candlestick range theory. When market, in instance, right? When market, and for instance, is on a bullish trend, and then it taps into a pivotal point, right? And right, it taps into pivotal point. We use a candlestick range theory to identify the bias of that movement. Now, like I used to tell every traders, you must have a 3-time frame that works perfectly for you. Your higher time frame, which is your directional bias, your mid-time frame, which is your structure, and your confirmation time frame, which I mean your entry time frame, right? Now, your bias, you want to know which or where the market is going into. Now, exactly, for instance, if we see this engulfing candlestick on the weekly chart, we know that market is ready to buy after a drop in, right? The market is ready to buy on the weekly time frame. Now, as a trader, once you find out this engulfing candlestick on the weekly time frame, you are expected to buy, or to dance to the tune of the higher time frame. If the higher time frame is in fact a bearish one, right? Then you want to look for a selling opportunity, right? You want to look for the selling opportunity, right? As soon as market starts, then you sell for that week, right? And if it is a daily time frame that you find such candlestick theory range, right? You do what? You want to, trade along the higher time frame. As soon as market taps into this higher time frame, and if market is going to drop backward, right, you should be making each or a lot of profit in the chart. Is that not it? Then, in that aspect, you find out your reason to take your sell or your buy. I hope I'm communicating with someone. You find a reason you need to take your buy, right, or your sell. So because, as soon as market got into here, 2-time frame below, which might be your 4 hours time frame, or your 15 minutes time frame, or your 1 hour time frame, right? Or your 1 hour time frame, right? Might be your confirmation for you to do what? For you to execute your sell or your buy, because it is W1 time frame. Now, a candlestick theory range, it's a large topic that you need to understand properly. Now, a candlestick theory range simply tells that when market, for instance, is within the weekly time frame, it's perhaps ranging. Now, the candlestick range theory makes us identify when market is ranging and then when market is not ranging, when market is trending. Now, don't forget we have the types of market structure. You have when market is ranging and when market is trending, right? Now, when market you have on the higher time frame, perhaps we focus on daily time frame and weekly time frame within the candlestick range. And then you have this candlestick on your higher time frame. Let's call this time frame the weekly time frame, right? And then the rest of the candlestick, the rest of the market has been moving within this range, right? Has been forming a series of candlesticks. The next candlestick that formed right here is a bearish candlestick. Let's say this is a bullish candlestick, right? And the next candlestick that formed, right, is a bearish candlestick. And let's call this a red candlestick. And then the one that forms next has a rejection, right? Let's say it has a rejection and has this candlestick also. Now, all these are still happening where within this high and this low of this candlestick. how I'm communicating with you. They are still doing what? Happening. We did this what? This candlestick. So once you get into your lower time frame, you would realize that they are all ranging, moving sideways. Sorry, they are moving sideways, right? They are moving sideways like this. Now, don't forget that one candlestick on the daily chart, it's 6 candlestick on the 4 hours time frame. It is 24 candlestick on the 1 hour time frame. And it is 48 candlestick on the 30 minutes time frame. How I'm communicating. It is 96 candlesticks on the what? On the 15 minutes chart. Now imagine all this one candlestick. Now this one and this 2 candlestick range just like this, not coming through, taking out this low, neither taking out this high. Then they are inside this candlestick. This candlestick is actually telling you that market is what? Ranging inside the previous week or the previous day. So what you want to look for now is the closure or the sweep out of the candlestick that was ranging. And this is where the AMD comes in place, the accumulation, manipulation, and distribution, right? So, and also this is where you know the market is ranging or the market is not ranging, depending on what you see. Now, let's get into the chart and understand this ranging concept I just talked about. Now, I come across this ranging at the on BTC USD, right? I come across it on BTC USD, and which I am going to show you why I said BTC, it is ranging because it has been ranging for how many weeks now, and then I would not want to just jump any trade without seeing a clear confirmation. Now, look into this properly. We have this low that creates this break of structure right here in it. Right then, we have this, excuse me, let me delete this. Let me delete all drawings, right? Clear my drawings. Now, let me delete this. So, right, so my chart can be clean. Now, we have this last candlestick. Look at it right here. This is the high of this candlestick, and this is the low of this candlestick. And what has the market been doing? Within this, just how many weeks ago? 1, 2, 3, 4, 5, 6, 7, 8. Within 8 weeks now, that's 2 months ago, market has been ranging inside the last, the 8-week ago candlestick. So if you go into, this is your 4 hour, this is a weekly time frame. Let's go directly to daily time frame. Let's see how it is on daily time. Now look at it, right? Is this a trending market? No, it is what? A ranging market. This is to tell you that this BTC currently, it is what? It is ranging. Now, once we have this sweep, and then we have a change of character, should be expecting market to come back to take out this low as well. And once we have this low first taken out, right, we should expect this market to come and take out this high as well. And this is all what we call accumulation, manipulation, and distribution. Now, they are accumulating currently from the weekly time frame. As you can see that it is just still within this particular candlestick, just like I explained on the recently while we were on gold chart, right? Now, just the same way, you can see that it is consolidating here all inside one candlestick. Now, this is one aspect to identify that market is currently ranging in your week, in your days or any fucking, I don't know, depending on the time frame. You understand? So now, if we go into 4 hours time frame, you see how well and how huge the ranging market is, and within that ranging market, we'll see different break of structure, like I am marking, but still they are within the weekly time frame range. So this is a particular jury range that you need to understand. Now we have a lot of candlesticks understanding that you need to understand properly. Now, this is one that I'm letting you know, and then this market is currently what? Ranging. So in fact, if you want to take your buy, right, you just know that this point, market has always been obeying this, this level right here. Market has been obeying this level right here, and then this until this point is swept away, right? Before we do what? Before we think of selling. All right. So that is how we all look into the chart when you are focusing on candlestick range theory, right? Therefore, we can still take this trade if you want to take the trade, because the weekly time frame is ranging, the daily time frame is ranging. So this is a break change of character, right? And then we have this low as inducement, we have this low as liquidity grab, right? But we have this unmitigated order flow right below right here, and then we have pools of liquidity resting below right here, and then we have this point of interest resting right below right here. Therefore, we have this inducement, we have this smart money trap, right? This 50 decisional order flow, right? Then we have smart money trap right here, and then we have this point of interest, which might be interesting for me to want to buy. Even if market drops below, I might be thinking of buying also to target this point, and then to want to sell again. So just take note of when market is ranging, and then you should be able to identify if they are within a particular candlestick, which is very, very important. It is very, very important, guys. It is very, very important. So this is one of three of the CRT. I'm going to teach you the the two of three. The second CRT. Also, this is when market is ranging for you to identify a particular ranging market. Now, the second CRT setup tells you that when market is perhaps selling, you have this pressure, right? But you then have a rejection. Let's say this candlestick then closes as a rejection candlestick, right? Then closes as a rejection candlestick. Now, then this rejection candlestick, let's say this also has a wick. Let's say this also has a wick. Then this rejection candlestick, right, now closes like inside the second candlestick, inside the second candlestick, right? If it closes like this inside the second candlestick, then we have another CRT, right? By the time you would check, we have a liquidity graph right here, right? It might close inside, and then this one turns to bullish. Anyhow it goes, but the interesting part is when it goes inside the previous candlestick, in that aspect, it is a perfect CRT. And what happens? You see the market change structure on the lower time frame, right? Might have something like this, then push up again, right? So in this aspect, we have a CRT. Now, once you go into your lower time frame, you will be seeing a perfect change of character like that. You'll be seeing something similar like this, right? Market selling, you'll be seeing something similar like this. And you have a change of character, then you would sell, you buy right from here. You want to understand. So this is how the CRT works. Now on the higher time frame, this is how it's going to look. On the lower time frame, this is how it's going to look. It's going to give it this change of character perfectly, but it's going to look like this on the higher time frame. So let's look into a scenario where it takes place. So we're going to be focusing on daily time frame because it's always best to be on the daily time frame and then to see what market is telling practically. So let's see this also. We have this sweep, right? We have this sweep and we have this, right? So let's see what happens right here. We have this sweep. Also, this is CRT because it happens right in the fair value gap right here, right? So let's go to an hour time frame. Let's see how it has happened. You would see that it is a change of character on the 1 hour time frame. So let's go deeper and let's see how it is. Okay, so this is it. Excuse me, the network is not good. So this is it, right? You can see that perhaps gives a change of what character, just like I've explained. And then what happened? This is a change of character. So what happens to cell, right? So this is the CRT concept, which is very, very interesting that you might want to add in your chart, right? So once you come across CRT, you should be able to identify. Now, this CRT is the reversal pattern. Let's assume you want to take a change of character, then you've seen that rejection on the higher time frame, which is the daily time frame, and which that rejection happens to be what? Happens to be your your change of character on the lower time frame, then you execute your trade, right? And I am interested to teach you guys also what we call changing state of delivery, which it's very, very, you can just try it 3 times of what you're risking, which is also a very, very interesting topic. And maybe in the next video that I will be uploading on my YouTube channel, I will be teaching you how this works perfectly. So this is, let's look for another example. Let's go into gold. Let's see another CRT, perfect CRT to be precise. And let's see if we'll get another reason. Let's see on daily time frame. No, gold has always been bullish, so it's not always quite good, right? To take trade selling. So let's see another buy. We'll have a CRT. But now let's see the weekly chart. We'll have a CRT, and then we'll go into the 4-hour time frame to confirm if it was a change of character. So the have a CRT right now. We now have a CRT. Now we now have a CRT. We now have a CRT. We now have a CRT. Let's go to another chart. Let's look for the CRT, and then we should look for that reversal pattern. And then let's confirm. Let me play this. Okay, let's do it this way. I don't want to play that chart. Let's do it this way. Let's move into this point, right? Yeah. So CRT, right? So this is our weekly chart. This is the candlestick, right? This is the candlestick. This is a rejection that sweep out this candlestick, and then, right? And then we have engulfing candlestick right here. Right here, we have engulfing candlestick right above. This is a sweep of this previous week candlestick. So it sweep the previous week, then it pass and engulf it. So this CRT is also a CRT candlestick. Now notice that this, after I sweep it out, then it didn't close above the wick again. It closed inside of the wick, then change it in fact to a bearish move. So this is a weekly chart, which is going to tell you another long story. Therefore, if you go into, this is a weekly chart, if you go into the 4-hour time frame, let's see that how that the particular point looks like on the 4 hours chart. So you can see how it looks like a change of what? Change of character on the weekly chart. In fact, if we are into the daily time frame, you should see also the change of character in it, because the way it looks, right, it's looking like, you can see, right, it also a change of character in there, right? Because this is high low, is the lower high, right? Lower low, then lower high, then before market traps it. So this is our change of character in it. So what would happen after the change of character happen? So we wait into market to come into this level, other block, right, represented, and then this other block has what? The fair value gap in it, with the fair value gap in it. So market has rejected right here. Now this is also an interesting CRT of the previous day. Takes out super this low, I mean this high. So we go into 1 hour time frame. What should we be expecting? A change of character. At that point, is that not it? This is also a CRT. You're expecting a change of character. Then we should be seeing market to, after this point closes, right? I want it to close right here. Then I should see market to come in and then short, a fucking short downward. You understand? So let's go. I've marked it out, right? Let's go into the 1 hour time frame, because this is the daily. Let's go into the 1 hour time frame. Is it a change of character? Right? Yeah, it is a change of character. See how interesting that works. I want to place it very well. This is it. And then it shifted structure. Wow, this is what you need to understand that. And then what happens? It created, in fact, an inducement which markets might want to look into, and then set you up, right? And then come back into this fair value gap for you to what, shoot your sell. An interesting model you need to watch out for when trading. So this is a CRT concept you need to understand. Also, very, very interesting, right? Very, very interesting. Now, let's now talk about what I called the institution-funded candlestick. Now, this is the second topic you need to know, institution-funded candlestick. There is a particular candlestick that the traders, the institutions formed, right, to deceive traders that, okay, this is a particular candlestick, a bullish candlestick. You can see that momentum of that candlestick. It's telling me that market will be buying, market will be buying. Then what happens? You jump into that trade buying, and all of a sudden you see market buys a little and then drops back, and what? Take you out. Now, because you are not aware of that institution-funded candlestick. Now let's get into institution-funded candlestick. How do you understand an institution-funded candlestick? Now, an institution-funded candlestick is always funded that you yourself, you will see that this candlestick is each candlestick that is telling us market is buying or market is selling. Market perhaps might be falling like this, right? Then create this huge candlestick and then do what? And then do something like this. Continue selling, right? A bit. Let me put a line there. And then continue selling. And all of a sudden, change back to what? To the bullish, change back to the bullish scenario and then cover it up. Now, what practically do I call this candlestick? Out of these three candlesticks, I'm going to use this second candlestick as my funded candlestick because it instigated this main funded candlestick. Now, this was the candlestick that was funded, but it was this second candlestick that instigated it. Now, it was just like you having fair value gap. You know what a fair value gap means? Having three candlesticks, right? But this must have to be of the same color. I mean, the same species. Let me put it that way. It must have to be the same species. Now, imagine that this is a fair value gap, right? You'll be expected to sell on this fair value gap, then to sell like this. The market now breaks it above. Then this second candlestick is what? Is your funded candlestick. What happens? Then market tap into this funded candlestick, then push upward. I hope I'm communicating. So also if you're selling, right? If you're selling, if you want to sell rather, when you have three candlesticks, like a fair value gap, right? Then the funded candlestick, then that came. Now this happens to be your funded candlestick, which it's a confirmation, right, for us, or perhaps for me to sell further. You all understand? Now let's go into the chart and let me show you how this actually works in the course of training. So let's go and look for a funded candlestick. Now, this is my funded candlestick. So this is my funded candlestick, the second candlestick, as you can see. This is perhaps the second candlestick, right? So towards moving up, we have this that caused the first selling pressure, and then this also the second one, right? That caused the second pressure, right? So this is funded, right, for this to be created to deceive traders that yes, we are still buying. So as soon as we have this block of structure with this momentum, traders will be what? Buying, right? And then when traders buys, what happens? Market takes them away. Therefore, they will be setting their stop loss right below, right here. But understanding the funded candlestick, as soon as you've seen market created this funded candlestick, then created. Now, before you assume or before you accept that a particular candlestick is funded, you must have seen a retracement. You must have seen a what? Retracement. Now, you must have seen the opposite candlestick to form. That's what I mean by retracement. Now, imagine that this was created, right? This was created, right? this candlestick was created, right? This was first created before this, isn't it? Now, after this was created, a break of structure, traders are interested to keep on buying, right? Because we have, you know, break of structure right here. Then they created this little candlestick. Now, not until a bearish candlestick takes place, like this candlestick takes place, right? Now, like this candlestick takes place, not until this takes place, then you would tell this as your funded candlestick. But if it doesn't takes place, this is not your funded candlestick. Any other one that form later on might be your funded candlestick, or this should be your funded candlestick. So what I'm saying in essence now is, now before I accept that this is a particular funded candlestick, I must have seen that market has or change the movement or given a bullish move right now. As soon as market give a bullish move, this now becomes my what? Funded candlestick. Do you understand? Now, before I said, let me choose another one. There is no funded candlestick. The only funded candlestick you would use might be right here, right? But it's not wide enough now. Before you say this is the funded candlestick, right? The next candlestick, the next two candlesticks, did they form a bearish candlestick? No, but this did not form a bearish candlestick. So this form a bearish candlestick. So you can't form after the bearish 1, 2. Now this 2 is your bearish, is your funded candlestick. Now if it's a bullish one, also, let's go to the bullish scenario. Also this, after this candlestick forms, this forms follow. Then this is the bullish candlestick that retreats back upward, right? Then after this opens, then we have this as a funded candlestick, right? Now because this is the second candlestick that created after the third candlestick created before the bullish move occur, which is this bullish move. Therefore, what you do? You buy immediately after the break to the upside. They break to the break to the upside of the funded candlestick. You might wait for the retracement to take place. Set your stop loss from this particular zone, and then you aim wherever you want to aim, 3 times, 4 times, 2 times, 1.5, any times you want to times your risk appetite. The world understand. So this is how funded candlestick is. So it's actually telling you that market traders funded. Now let's look into another pen. Right, let's look into another chart rather. So now within this 1, 2, 3 candlestick, where is our funded candlestick? This, right? Yes, you're correct. So this is our funded candlestick. Now, why is it this? Because the next candlestick also must have this bearish. Now, if this bullish candlestick is not there, that this candlestick also was a bearish candlestick, then the next one that now happened after this candlestick that we assume that was bearish is not bullish, then this will not be our funded candlestick. But after this, it was a bullish. So this is our funded candlestick. So let me show you another practical example of the what is it called? Of the IFC candlestick. Right? Let me show you another one. Now, this also is a funded candlestick. Market perhaps funded it very well. So this is this one. Now, this point right here, it's kind of tricky, but you have to wait and see, understanding the candlestick. Now, you see market created this. Market created this. Excuse me. Market created this first candlestick. Market created this second candlestick. Now, this third candlestick, right, has little candlestick. So therefore, this I would not say it's a funded candlestick. So I would rather choose this as my funded candlestick, this candlestick as why? Because this and this, I would say they are one together. Do you understand? This and this, they are one together. It's just a 50% of this that later formed. Then if you add it up, you will see that it's just one candlestick. Do you understand? So this is now my funded candlestick right here. So immediately market taps it. And then that's the tricky part of it. Now, market sometimes tap in the funded candlestick themselves. a little bit. Sometimes if you want to break it will give you, tap it, sells a bit, then break it massively, just like that. And sometimes market might just do what? Market might just break it, the funded candlestick, market might just break it, then come back to test it, then push up. So it all depends. So therefore, you can place your buy stop immediately after you've seen this kind of reaction. You can place your buy stop above right here and set your stop loss below right here. Now, as soon as market begins to pump up. So if you see this kind of scenario whereby it first of all tested a funded candlestick and sells back, right? It means what? It means you can use your buy stop. Now, if you see a scenario where I show you just recently, right? Now this scenario, this is a funded candlestick. This is candlestick one. Okay, there is no funded candlestick right here because this candlestick is inside this candlestick, and this candlestick is inside this candlestick. So it's just like one candlestick. This two is one candlestick, and this two is another candlestick. So it is not up to three candlestick, right? Let's see. Um, let's go to another pair. Let's go to another pair. Let's go to another pair. So, all right, this is GEO again. So now let's see. Okay, I think I've explained this GEO again. Let's see if we can see GBP JPY. Let's see if we can see GBP JPY. Okay. Now this is what will be our funded candlestick. This is our funded candlestick. This is my funded candlestick right here. This is my fund because why? We have this for this candlestick, then the next candlestick is a bullish. So before that candlestick, this is the second candlestick, and it was funded, right? Therefore, I'll be expecting market. You can see as market taps into it, it retreats back. So I'll be using what my buy stop right here. Immediately I've seen the market has tapped it, the market retreats. Then I'll be using my buy stop right here. And then I'll be using, whatever you want to aim, 3 times, 2 times, right? Let's say 3 times because it's still going to get into that point, right? It's still definitely going to get into that point. So you can aim your 3 times, 2 times, like that, and like that, and like that. So that is how you identify your institution funded candle. Now, this is also an institution funded candle. Was it the second candlestick right before the retreat? So this is a red candlestick, this is a bullish, this is a red candlestick. Now, market, you see that as soon as market did not break past this low, we are still safe, right? So if market breaks past this low, we are selling. But as soon as market has not broken past that low, we are still buying. So that is how the IFC candlestick works. I hope you learn one or two from this particular video. If you learn one or two, just like, give a comment, and kindly share. Make sure you subscribe to my particular channel. Let's boost the channel so you can ginger me and add more. And in fact, I've do a video of SMC from beginning to the end. So I will see you guys in the next video. Have a wonderful day ahead, and make sure you maintain your risk management, which is very, very important. See you guys later. Bye.